Hi everyone. We'll just get started in a few minutes, give people some time to log in and get their computer set up. Hi, just for those who just joined us, I'm going to give it another minute to give people more time to log in. So just sit tight, thanks. All right, we're just going to get started now. I'm sure people will be logging in and signing on in the next few minutes, but we'll just quickly get started. So I just want to say welcome and good morning to everyone. Thank you all so much for being part of the discussion on the federal tax debate and its implications for California. My name is Sabrina Ham, and I'm the statewide coordinator for the California Asset Building Coalition. And I'd like to give a very special thank you to the California Budget and Policy Center for co-hosting today's webinar. The focus today for the webinar is looking into how the tax plan will impact California. We planned this webinar and we weren't really sure what the final vote was going to be or how it was going to play out. And as of now, the Senate vote is still pending. But regardless of the transition and all that, we are excited to host a webinar on such a timely topic. We have about 150 people who registered today, and that was very exciting to see. I encourage all of you to submit your questions in the question queue on the right side of your screen. You also can tweet during the webinar and use the Twitter handles and hashtags for our organizations. And if you'd like to tweet out your questions, feel free to tag at Cal Assets or at Cal Budget Center. So if we can just go to the next slide. Thank you. So during the webinar, we'll hear from Emmanuel Nieves, the Senior Policy Manager from Prosperity Now, followed by Chris Haney from the California Budget and Policy Center, who's the Executive Director, and Amy Matsu, the Senior Counsel and Director of Government Relations at the National Women's Law Center. So thank you all so much for joining us, and I will now pass it off to Emmanuel to start us off. Thank you.
Perfect, great. Thank you, Sabrina, and hello, everyone. Thank you for joining this webinar. It's a very timely webinar, as Sabrina was mentioning. As she mentioned, I'm going to walk through kind of very quickly what the bills that are being debated mean for asset building and a couple of broader issues. So if you could just advance to the next slide, we can start here. Perfect, thank you. So I think before I get into my slides, it might make sense, to take a step back for a moment, and before diving into what's happening in Congress and what's being debated, to just take a step back and give a bit of context about how our current federal tax code works as it relates to asset building. So as many of you might know, our federal tax code is, by leaps and bounds, the single largest asset and wealth building tool that the federal government uses to provide families with the support they need to boost economic outcomes and build lifelong wealth. And in order to achieve these goals, the federal government spends over $500 billion each year to help families purchase a home, go to college, save and invest for the future. And in fact, just last year, it spent about $677 billion, through the tax code to support these asset building activities. And just to put that kind of amount in perspective, that's more than the budgets of all federal agencies combined, except for the Department of Defense. And so, yet while the government's goal of helping families build wealth and assets is laudable, and we should be, commending it, and it's praiseworthy, the problem is that the bulk of this current support ends up going almost exclusively to the wealthy, providing very little to no support to low and moderate income families. And so to this point, as you can see on this slide here, in 2017, millionaires received more than $160,000 from the asset building tax programs listed here, or at least the categories listed here, while a family earning about $50,000 received just $225. And so as you can see on the next slide, perfect. So as you can see on this slide, what we currently have, I think, is in essence, or what I was describing is that, what we have in essence is an upside down tax code where the vast majority of tax benefits go to those at the top and not to those who really need that support. And so we here at Prosperity Now and plenty of other organizations, including many on this call and including the organizers, have been advocating for just the opposite, a tax code that is equitable in its distribution of benefits, that provides opportunities such that provide support and boosts needed to lift up our most vulnerable, those in the working class and those in the middle class trying to build long-term wealth and assets. Unfortunately, instead of aiming to create such a tax code, the tax plans currently being considered by leaders in Congress and in the administration would make this problem even worse. And so as you can see on the next slide, despite the rhetoric that the tax bills are Congress would benefit all Americans, especially those in the middle class. Recently released nonpartisan analysis by the Tax Policy Center, which is visualized here, the Congressional Budget Office, the Joint Committee on Taxation, have all shown the opposite to be true, as a clear majority of the benefits from these proposals end up flowing to the top 1% and the top 0.1% of Americans. And so as you can see, when it comes to the dollar benefits of these tax plans, those benefits, the benefits at the top greatly dwarf those that go to the middle class and those that would go to our most vulnerable. Add to this that over the next 10 years, these cuts for these families would shrink, while the cuts for the richest would go up. And what you end up getting is a version, kind of an extreme double down of our already upside down tax code, which is clearly evident in this slide under the Senate tax plan, which they are planning to vote on today, where the poorest families end up getting a tax hike once this bill is fully phased in. And so while these graphs are a little bit, fairly straightforward about the impact that these bills would have on most Americans, there's a lot here at stake that really kind of might go unnoticed if we just continue focusing on the numbers. So I'm going to cover 3 issues in particular, and while we can cover a whole lot of ground, I think these 3 might help to anchor some of the conversations that will be happening later on. And so the first of these, as you can see on the next slide, is that the tax bills being considered and possibly voted on later today are only going to make the historic levels of inequality we face today even worse. Currently, without these tax cuts, we're at a point where the wealth of the elite vastly overshadows the collective wealth of the majority of Americans. And in fact, to this point, a recent report by the Institute for Policy Studies found that the wealth of just 3 Americans, Bill Gates, Warren Buffett, Jeff Bezos, outweighs the entire wealth held by more than 160 million people. I mean, these are levels of wealth inequality that we haven't seen since the 1930s. And to put what these tax cuts might mean in even more perspective for the future of wealth inequality, consider that the last time our tax code was truly reformed, during the 1980s, the wealth of the Forbes 400, which these 3 individuals are part of, has skyrocketed from $231 billion in 1982 to $2.68 trillion in 2017. Now, with that said, the second thing that's at stake here that is related to wealth inequality and kind of a more specific branch of it is the racial wealth divide, which, as you can see on the next slide, has exploded over the last 30 years. And so, as you can see here, between 1983 and 2016, the wealth of Black families has decreased, while the wealth of Latino families has increased, substantially on both ends. But when compared to what's happened to the wealth of median white households over that time, which has gone up by more than $34,000, reaching $140,000 in 2017, you can see that we've had a kind of a gaping racial wealth gap over the last 3 decades. And so while these figures are alarming, you might be wondering, what does this have to do with the tax code and the plans that are being considered in Congress? Well, a lot, especially since the racial wealth divide is kind of a byproduct, or it is a byproduct of decades and generations of bad public policy that have worked to the economic benefit of white households and at the expense of communities of color. And so, as you can see on the next slide, not only does the tax code overwhelmingly benefits households and individuals, wealthy households and individuals, it also overwhelmingly benefits white income earners across the board, which is much more clear on the next slide. So as you can see here, not only are the wealthiest individuals in the country going to benefit from the tax code or the tax plans considered by the Senate and already passed by the House, but they will overwhelmingly benefit white households across the board. And so, while non-Hispanic whites account for about 62% of the population, they end up making about 80% of those in the richest 1.1%. By comparison, Black and Latino families, which account for about 30% of the population, make up just 3.2 and about 5% of those wealthy and ultra wealthy families. On the opposite end of the spectrum, the dynamic is kind of the opposite, with an overrepresentation of Black and Latino households among the poorest 1/5 of Americans. And that's where, as we note here, is where not only are these families getting less back from these tax plans, but in some cases, they might end up paying more in taxes down the road. And so, as you can see, the last thing I wanted to point here, which you'll see on the next slide, is what this bill means for the program that you, your organizations, and the many people that you serve depend on to do good work, to help people move up the economic ladder, and to help families make ends meet. And so, if this bill becomes law, the benefits that will come from it will eventually come at the expense of funding for critical programs such as healthcare for seniors, education, and food assistance. But these are estimates over the next 10 years. I just want to emphasize that we shouldn't ignore the fact that Republicans are likely and already not going to wait for eventually to come, as the Senate bill includes instructions that would see Medicare suffer an automatic $25 billion cut next year, a cut that could potentially impact access to healthcare for more than 58 million Americans. Unfortunately, that's just kind of the first step in these cuts and this kind of cascading effect if these bills are passed, as Republicans are in essence, creating a crisis with this tax bill that would lead them to cry foul within the next several years that there isn't enough money to fund these critical programs. Once that happens, there'll be messaging, there'll be things like that, but what will come is more cuts, including the likelihood of a full-blown push to do quote-unquote welfare reform, as the administration, the president, and even members of Congress, such as Senator Rubio, have either alluded to or explicitly stated that will come next after, if and when this tax bill passes. So with that, I'll stop there and I'll pass it off back to you, Sabrina. Thank you.
Hi, thank you so much, Emmanuel. I know I got a few things about the slides jumping around. We're going to do our best to work on the technology. So just keep, inputting your questions in the panel. And now I'll pass it over to you, Chris Haney, to give us the update.
Great, thanks, Sabrina, and good morning, everyone. Thanks for joining us on the webinar today in real time as the final debate in the Senate is advancing. So let me start by saying a little bit just about the latest news with where things are. As most of you are probably following in some capacity, you know that the Senate has been going through their 20-hour vote-a-rama process, as they call it, and is nearing a final vote on the Senate version of the GOP's tax bill. They're expected to vote later this afternoon or evening, or at least that's the expectation that is out there right now. The latest news in the last hour is that they appear to have the 50-plus votes that are needed to pass the bill. We'll see what happens when that comes to a vote, but there's been a lot of horse trading going on in order to try to appeal to those holdouts in the GOP Senate side who have been expressing concerns, whether that's Susan Collins in Maine or Senator Corker or Senator Flake. And the latest news in the last couple of hours was that Senator Flake in Arizona had expressed his support for the bill, which is the vote that seems to have put the process in place for them feeling like they have the votes to pass the bill. So that's where things are as of now. There's still several hours away before they could take that final vote, and there may still be other events that transpire as they figure out whether they'll be able to take a vote or they'll be able to pass it. So that's what's happening right now. What happens next in terms of if they do have the votes and they do pass the Senate bill later today is particularly important in the political context of California, and there are two pathways that could be pursued. First, the typical pathway would be a conference committee of the House and the Senate that would be convened to resolve the differences between the two bills. Remember, there's a House tax bill that was passed a number of weeks ago, and the Senate tax bill looks somewhat different. While they have some things in common, like their business tax rate decreases, there are some fairly large differences. Most notably, the Senate bill includes a repeal of the individual mandate in the Affordable Care Act, or at least that's reportedly been something that will be in the bill. And that's not in the House bill, so that's a big piece of the tax package that would need to be resolved between the two houses. And if they have this, go through this conference committee process, that means there'll be some time, maybe a couple of weeks before they reach a final vote that would need to be taken in both houses in order to pass a reconciled package that looks the same in both houses. So that would be the typical process, and it would provide some time for both opponents and proponents to make their cases against or for the final package. The quicker route that could follow very soon on the heels of the Senate vote is that these behind the scenes leaders in the Senate on the GOP side and in the House on the GOP side could strike a deal that basically allows the House to just take a vote to concur with what the Senate bill looks like when if and when it's finally passed. So that could happen very soon. Presumably they could even do it over the weekend if the Senate were to pass this later on this evening. So there has been a lot of conjecture about which pathway will be pursued. As of a couple of days ago, a lot of insiders in Washington, D.C., longtime observers of federal budget issues, had been suggesting it was headed more likely to a conference process. But everyone who is watching is also watching very closely for signs of some sort of rapid House vote that would simply concur with the Senate. And that would be particularly alarming in many respects for California, where our 14 GOP Congress members would be taking a vote very quickly without very much known in terms of the details of what's in the Senate packet. So that's those are the issues about what happens next. Before I talk a little bit about the tax bills that are in the Senate and the House, I did want to say that we need to remember that the tax cuts don't happen in isolation, and there are significant implications for the federal budget. In fact, we need to remember that what triggered the process that led to the tax bills in the House and the Senate were budget resolutions passed in both houses that actually called for significant federal budget cuts that would come with federal tax reform. For instance, a call for $1.5 trillion in cuts to Medicaid over the next 10 years, $500 billion in cuts to Medicare over the next 10 years, big safety net cuts, and somewhere in the range of around $1 trillion in cuts to other discretionary programs at the federal level. So those pieces are there. They're not individually in these tax bills, but they were part of the overall plan that was put forward that enabled these tax bills to come forward. So just wanted a reminder that those pieces are out there. The earlier note about some GOP senators have been saying things like, there will be cuts to things like Medicare and Medicaid and other entitlements that will come up next year. That's all related to these budget resolutions that have already been talked about a bit previously that set up these tax bills. So let's talk a little bit about what's in the tax bills and who benefits and who doesn't. First, that's who benefits. This is the Senate tax plan, but the House plan as well, as has just been outlined before me. The tax plan's heavily tilted toward the wealthiest corporations and households, and that happens through the corporate tax rate being reduced from 35 to 20% if current plans hold. It happens through what's called a pass-through rate that allows sole proprietorships, hedge funds, various real estate sorts of companies to pass through certain income in a way that they would pass it through at a lower tax rate. So in other words, they'd be getting a lower tax rate overall. Repatriation of profits that have been sheltered offshore, an estate tax, a doubling of the estate tax, which for all intents and purposes basically nearly repeals the estate tax entirely, removing things like the alternative minimum tax, which is a piece of our federal tax code that is in place to try to ensure that people who can write off a lot of their taxes owed pay some minimum level of taxes in a given year. That would be repealed as well. So there's a series of these corporate and individual tax breaks that are primarily used by the wealthiest households and corporations that are all significantly cut or eliminated in some fashion. And a key thing to remember there is that particularly on the corporation side, those provisions are made permanent, and that ends up being a key difference with some of the other pieces I'm going to talk about here next, which is, so the question is, how do you pay for a tax plan that's so overwhelmingly tilted towards corporations and wealthy households? Well, you in essence, in order to do that, they're doing three things. They're balancing it on the backs of low and middle income households over the next 10 years. They're balancing it on future generations by adding significantly to the federal deficit, and they're particularly targeting states like California. So let me start with the low and middle income households, as was shown in the earlier slides. There are these initial or small tax cuts that are there in the initial years for low and middle income households. But it's important to note that in the Senate version of the bill, almost all of those provisions sunset by 2025, and then the tax rates increase again by 2027, such that those households would be paying more than they're currently paying. So that's the key difference with the corporate provisions, where those corporate cuts are being made permanent, the individual cuts are being made temporary. Much of what that looks like for an individual household depends a lot on individual circumstances. For instance, do you own a home and itemize your taxes? Or in the case of the House bill, which would take away some exemptions for medical benefits and student loan debt, do you have high levels of medical expenses or student loan debt that cause you to itemize your taxes in order to reduce those costs? So a lot of what it looks like for individual low and middle income households on the tax side depends on your individual circumstances. But the key thing to remember for those households is, even in the cases where they're getting small tax cuts, they're going to be significantly hit in a much larger fashion by the budget cuts that are inevitably going to accompany what are in the tax bill. So, for instance, the repeal of the individual mandate in the Affordable Care Act would endanger the health insurance for millions of Americans and almost assuredly raise premiums for those folks who are obtaining health care through the exchanges, or what we call covered California here in California. And the set of other cuts to Medicaid, Medicare, safety net programs, non-defense discretionary programs like programs for affordable housing, those are all programs and services that are primarily benefiting low and middle income households, and the costs that would be the burdens that would then be imposed on those households are going to far outweigh the $50 or $100 or $400 in tax cuts that are temporarily there in these tax bills. And so that's the kind of quick version of the low and middle income side of this. These bills are also balanced heavily on future generations. I'm sure everyone has seen various sorts of measures of what the potential impact is in terms of the federal deficit. The rules under which they're operating allow them to add $1.5 trillion to the federal deficit over the next 10 years. But as many folks have probably been following as well, you'll note that one of the little nudge wink things that most folks in the GOP are saying about the deficit side of this and those temporary tax cuts for individual households is that they will eventually extend those tax cuts rather than allow them to expire. And that essentially means that the $1.5 trillion addition to the deficit is not a true measure. It's more likely that there'll be somewhere in the range of $1.9 to $2.4 trillion added to the deficit. And that's a huge number. I mean, if you just take the $1.5 trillion number, that's 7 times the size of the California General Fund. So these are big dollars, big liabilities that are being added on to future generations. And then lastly, I wanted to note a couple of things just about the particular hits to California here, because there are several provisions that are actually particularly going to be hard hitting for California. Most notably among those would be the state and local tax deduction, which is a deduction that taxpayers receive. They get to deduct the taxes that they pay on their state income, sales, and property taxes paid, so that they're not having to pay taxes again on those at the federal level. That deduction would go away entirely under the current version of the Senate plan, and states that have higher sales tax rates and higher income tax rates, like California, where therefore our taxpayers are paying a much larger share of the funding, or out of their larger share of tax bills, they would be harder hit. Very similarly, the repeal of the ACA mandate would certainly impact states where we have expanded the Affordable Care Act in significant ways to allow people to access health care. And very similarly, a lot of the safety net cuts would have larger impacts for California. So I've probably taken too much time. I'll stop there and turn it over back to Sabrina. But just want to reinforce that this is a tax plan that is overwhelmingly benefiting very few, very wealthy people and corporations, balanced on the backs of everyone else. And we're going to hear a bit more here shortly about how what those implications are for women in particular. So thank you, everyone.
Hi, thanks for that, Chris. It's really important for us to sort of hear what is going on as we are speaking, actually. So sorry for the technology issues, so please bear with us again. I'll now pass it over to Amy, if you can, we'll get started now.
Thank you so much, Sabrina, and thank you for all of you who are on the webinar today. I'm really, it's the wrong word is excited, but this is a really important subject, as Emmanuel and Chris have described earlier, and so I'm grateful to be part of this discussion for California. So I'm really quite indebted to the amount of detail and information that you've already gotten about the tax plan and what's in it in the previous two sections of this webinar, but I want to turn a little bit of a focus on how this plan impacts women and families in particular. Next slide, please. So as you know, we're looking at the proposal for changing the federal tax plan. One of the things I think it's important to harken back to is, you know, as Emmanuel mentioned in the beginning of the presentation, the federal tax code provides significant incentives for doing things that we think have a societal benefit, like owning homes, saving, getting ready for retirement. And so those are the underpinnings of the provisions that encourage asset building. And another piece of the kind of the tax code's policy is that there are provisions that are targeted towards helping working families with children who are really struggling to make ends meet. The tax code has provisions that encourage work, that increase income, and those are tax credits like the Earned Income Tax Credit and the Child Tax Credit. Those are refundable tax credits that every year lift millions of women and children out of poverty. They are an important work incentive that, you know, has been proven to be more effective than federal welfare programs, although that's not a surprise to many of you who've worked on those policies. And in addition, the income that derives from those refundable tax credits has incredible impacts on children's outcomes for health, other economic measures of success, their future success in school, and their future employment. So that is an important piece of the tax code, and if the tax effort underway right now were truly focused on benefiting women and families, that is a place where the efforts might be particularly targeted. Instead, what are we seeing? We're seeing, as Chris and Emmanuel have explained in detail, that this is a tax plan that is undeniably slanted towards the extremely wealthy and to corporations, the top 1% of earners and even the top 0.1% of earners, as well as larger corporations. So where the benefits of this package are not going is toward, for example, female-headed households who are underrepresented in the top quintile of households where many of the benefits are going versus overrepresented in the lowest income quintile. More broadly, over 87 million families with incomes under $200,000 will actually see a tax increase, according to the Tax Policy Center, under the Senate's plan. And specifically, in the last couple of days, a Tax Policy Center analysis looked at families with children and saw, although in this slide I think it's obscured by this nice baby's head, by 2027, families with children who are in the bottom two income quintiles would overall, on average, see their taxes increase. Next slide, please. So I wanted to highlight a couple of the provisions in particular and think about, in very concrete terms, how the pieces of the GOP tax plan will impact women and families. So as Chris mentioned, one of the most significant provisions in the Senate bill is the repeal of the individual mandate, which will have the effect of eliminating or causing the loss of health insurance coverage for 13 million individuals over a 10-year period. And so I think this is one of the things that is actually galvanizing a lot of activity around the country, similar to what we saw during the ACA repeal efforts, which is that the ability to be able to see a doctor and have that covered instead of waiting for an extremely the most kind of dire moment when you need to see a doctor to deal with pre-existing conditions or to help with chronic conditions is extremely significant, as you all know, to the economic security of families. And so this is a provision that will cause an extreme amount of chaos in the marketplace, increase of premiums, in addition to the loss of health insurance. In particular, I think that there was research done showing that this has a significant impact also on young adults who are covered under their parents' health insurance plans, and that's kind of purely tied to the repeal of the individual mandate. Also, as Chris mentioned, the state and local tax deductions hurts families who are in high tax states because that is an increase that they will face. And at the same time, because state and local taxes are used to fund, the revenues are going to services that families rely on. And so in that sense, because there will be a disincentive to have those higher taxes in states and localities to fund the programs and services, the loss of the tax deduction may put increased pressure to reduce those taxes, which will have kind of a downstream effect on the programs and services that those fund. And then finally, another thing I want to highlight is that the tax code also has a number of provisions that are supposed to help people with the costs that they incur just for going to work. So this can include the deduction for moving expenses that are related to employment. There are some kind of transportation-related subsidies that employers offer for which they can deduct the costs under the tax code. There is a deduction for people to offset the costs of union dues or uniforms, and those are provisions that are going to get eliminated under this bill. So these are kind of smaller provisions, but ones that people are used to claiming because they really address the costs that people face just by going to work, and those provisions that are going to be eliminated under the Senate plan. And I think, as folks also mentioned, there are other provisions under the House plan which may then get incorporated into the conference report, and those include the loss of the deduction for student loan interest. And we know that disproportionately women of color are burdened by student loans, and so this is one that would hit them particularly, in addition to the medical expenses deduction, which will also be harmful, especially for older folks. Next slide, please. In addition, I want to reiterate the second kind of bite at the apple. So the first cost that women and families will face under this tax bill are the increase in taxes that are due to the particular provisions of the GOP bill. And in addition, the cuts to programs and services that will result from the increased deficits that we will see as a result of this bill will also disproportionately hurt women. So in particular, I want to highlight some of the budget cuts that were proposed in the recent congressional budget proposals. Those include cuts to Medicaid, as Chris mentioned, and I wanted to highlight that Medicaid provides health care coverage to over 33 million women and girls. Women comprise more than half of adult Medicaid recipients, and so this is a cut going to hit low-income women particularly hard. In addition, nutrition assistance is an area of the budget that was targeted under the congressional proposals, and women comprise the majority of adult SNAP recipients in fiscal year 2015. And then we're also assuming that with the increased focus on reducing spending and reducing revenue, with the reduced revenues, programs that may not have been targeted in this round of congressional budget will eventually be targeted for cuts. And so one of the programs which is significant for women, women's employment, and for the health and well-being of families is the Child Care and Development Block Grant, which is the largest federal program which funds early education and child care. Next slide, please. So I also wanted to highlight a couple of pieces of the Senate bill in particular that have been highlighted as beneficial for families. I will say that this is not an argument that has been at the forefront lately because I think the political story about the fact that this bill needs to pass and the fact that provisions are changing so quickly in order to do the horse trading that Chris alluded to get the requisite votes. But in particular, one of the provisions of the tax plan that is supposedly helpful for working families and for middle-class families is the increase in the standard deduction. It is nearly doubled, although not quite. But I want to highlight that although this is an increase in the size of the standard deduction, it is offset for families with children because personal exemptions are eliminated. And so if you have a family with a couple of children, the loss of those exemptions almost completely eliminates the benefit of an increased standard deduction. In addition, many of you may have heard about the proposed increase to the child tax credit. And as I mentioned, the child tax credit is a refundable tax credit which is meant to help with the costs of raising children and has a significant anti-poverty effect. However, as written in this proposal, the bill provides limited benefits for families on the very lowest end of the income scale, but it makes the increased $2,000 child tax credit immediately available to families making $500,000. And so while it offers kind of a token amount for a mother who's working a minimum wage job, for families at the upper end of the income scale, they are getting the full benefits and really getting the bulk of those improved credit amounts. Finally, I wanted to highlight with the child tax credit that they are looking to impose a requirement that children who receive the refundable portion of the child tax credit have to provide a Social Security number. This is different from current law, and it would prevent families that have basically dreamer children from receiving the child tax credit, which they currently can do. So not only does the improvement in the child tax credit not primarily target lower income families, but it is taking away the benefit from some families who already receive it. And so the child tax credit proposal is very much a bait and switch. And then finally, I wanted to mention that there is a very small tax credit for businesses that's meant to encourage them to offer paid leave. Unfortunately, it is not a large credit. In addition, kind of other tax credits for employers have demonstrated that it's not a very effective incentive for having new businesses provide paid leave or other benefits. It mostly kind of reimburses companies who are already offering them. In addition, this credit, even though, as Chris mentioned, all of the personal income tax provisions expire after 2025, the paid leave credit expires in 2 years. And so if you think about the fact that it may take a company a year to put together a paid leave proposal, they only would be getting the benefit of this tax credit for a year, and that's not likely to provide a significant incentive. So the bottom line is that this tax bill, even the pieces of it that are being described as beneficial for women and families, really don't provide the benefit that they're touted to do. Next slide, please. So as I mentioned, and this is a little kind of hard to look at when we look at what we're facing with the enormous deficits and the cost of this bill, but it is, I think, helpful to refocus on the kinds of investments that truly would help women and families with children. So that would be to fully fund the programs in the budget which currently are being targeted for reduction. It would be to invest in childcare and other programs and services that we know boost families' economic security, ability to work, and outcomes for children. And in addition, to focus on improving the tax credits that are in the code for families with children and working families, which we know, if they're made refundable and more generous in a way that really does get to the lowest income families, could truly improve their economic security. And on the last slide, I have a couple of resources that are available from the Law Center, which do focus on women and families. in case they're helpful for all of you. And with that, I'm going to turn it back over to Sabrina.
Hi, thank you all. Thank you so much, speakers, for your time here today. So we are now have about 15 minutes left for Q&A, so please continue to enter your questions, and I will do my best to try to pose them to our speakers today. So, and a few of you have asked about the PowerPoint slides, so we will have those posted within the next hour or so on the California Budget and Policy Center website, along with the California Asset Building Coalition's website. So we will send you all an email when they're available. So feel free to share the slides with your colleagues and other people you're working with. So I have one question here. So, all of this is very hard to hear, especially for those who are, working to try to alleviate poverty and, address issues of the wealth gap. So what can we do on the state level, on the, legislative side, sort of help combat and have more reaction to what is posed in the tax plan today? Maybe I'll start with you, Chris, if there's anything that you'd like to share on that.
Well, I think the short answer is that we have to buy some space and time to respond, and I think that the 2018 will be, and the 2018-19 state budget deliberations will be, will have essentially set aside some time and space for state leaders to respond if needed, if there's some huge impact to the state, like what would come from this tax bill. And I know there are already conversations that have started with state legislative leaders behind the scenes that are looking at how to fill the gaps that would be left, both on the revenue side potentially and in filling the gaps in terms of backfilling some of those services that might be cut in the health and safety net arenas.
Great, thank you. Amy, did you have anything else to add about what can we do on the state level?
So I think that there are pieces that obviously need to shake out a little bit. And I will say that, in the first kind of line of offense is I think that there's still an opportunity to weigh in when the bill goes to conference. And so I think there's an opportunity for people and organizations to make their voices heard at the next phase when this is in the House. But I also think that at the same time that there are going to be increased pressures depending on how the final bill shakes out. Increasingly on the federal level, organizations like Minds International have been looking to the states to be leaders, and so this is really an opportunity for states like California, which have really been at the forefront of counterbalancing some destructive federal policies, to be cutting edge and to be leaders in the national discussion around helping women, families, lower income folks, and offsetting income inequality.
Great, thank you. Emmanuel, did you have anything else to add as well, or?
No, I think just to echo Amy's point, depending on what happens today, there could be an opportunity to continue weighing in, and if there is during conference, then we shouldn't, we shouldn't give up. We should try, work your contacts, reach out, propose ideas, and try to get some changes that could be, beneficial to your state and to the folks that you serve.
Great. So I have another question from a panelist. Is there any chance to legally change the SALT deduction changes as essentially taxing personal income twice?
So this is Chris. I don't think that there's much legal recourse there in terms of some sort of legal restriction from them actually repealing the state and local tax deduction. It's a deduction allowed by the federal government, and therefore it can be taken away by the federal government. It's a significant breach of over 100 years of the federal and state and local government compact, which was, basically that local governments and state governments would be given the space to raise their own taxes, to provide their own services, and that we wouldn't double tax individuals for taxes they're already paying. So it's a significant step back, but I don't think there's, I'm not a lawyer, but I don't think there's a lot of legal recourse there to stop it. It's significant that you have governors, state legislators, mayors, council members, county supervisors, all of the organizations that represent those individuals across the country have actually vocally voiced their disapproval of these tax measures. And so we just have to keep the clarion call going about that being a really bad deal for everyone in the country and it being a particularly bad deal in California.
Great, thanks. If you have any other questions, please pose them now. I have a couple more lined up, so we're getting near the end of our time here, so please don't be shy about submitting your questions. So I just have another one. It says, regarding the 4% low-income housing tax credit, are there any policy options for either California or the federal government to create a mechanism to utilize the 4% credits? Would anyone like to take a shot at that?
So this is Chris again. I haven't looked at the California options in this regard, but presumably the answer to that question is yes. California can govern its own tax code, just as the federal government can govern its tax code. And I think anywhere that the federal government is retrenching in some regard, there are options for California to decide to backfill what the federal government is giving up. And that's true on some of those kinds of tax credits. It could also be true, in terms of what California does with its own corporate tax rate or what it does with its individual tax rates or, an estate tax or inheritance tax, anything where the federal government is stepping back and leaving California in a lurch, leaving Californians in a lurch in terms of the services that Californians are receiving. The state has some options through its own tax code to decide, how much we're able to do to make up the difference.
Great, thank you. So another question, we'll start with Amy. In this, final hours of the vote and, unsure what's going to happen, what messaging do you think we could get across to the senators and, and the wider public of, like, if we were to choose maybe one main message, what could we really try to push for?
So I'm inclined to say that focusing on the impact of the loss of the individual mandate, both because that was the loss of health insurance and the impact on people's health and well-being and that of the most vulnerable in our society, the elderly and children and the disabled. That I think is a very persuasive thing to weigh in about. I think also at this point there's really a question about volume and intensity, and so that's another reason I think that focusing on the health-related impacts of the tax bill may be a good last-minute strategy. And I think that there's also a very just visceral concern about this is not good government. This is not how governing should happen. When at this point, hours before final vote, we don't know what's in the bill, and neither do the people who are voting on it. And so I think the things that make people the maddest are what they should weigh in about.
Great, thank you. Amanda, did you have anything else to add about a key message that we can try to push along in the final hours here?
Yeah, I think making the point that this bill, doesn't benefit the folks that it claims to benefit, showing the data, showing the impact not in the near term, not just in the short term, but also over the long term, and connecting it back to critical programs and support. And I think the last thing I'll say is that this bill is particularly unpopular, and part of that is because there is no, I think, constituency for a bill that gives billions of dollars, trillions of dollars to the wealthiest individuals and families out there when so many people are struggling. So I think trying to bring that back to the forefront about how skewed this bill is and who really benefits from it would be something to keep in mind as you continue to advocate against it.
And just to pick up on that, the opportunity in California is really those 14 members of our congressional delegation who still, one way or another, have a vote to take. And 3 of those individuals voted no on the House version of this bill, largely driven by the concerns about the state and local tax deduction issues and the concerns that basically that the bill wasn't, the tax bills were ultimately not going to help the middle class. So those are going to be messages that may work with particular folks in California.
Thank you all so much. So I just have one more question as we wrap up. So do we know exactly how much the repeal of the local and state tax, the federal state tax, will cost California taxpayers annually, or any figures around that? I'm not sure who would be the best person to answer, so feel free to jump in.
We know both we know both estimates of the dollar amounts and the number of potential taxpayers that are impacted. And I'm sorry, I just don't have the details sitting right in front of me at the moment, but we can share that in some other ways. You can send us a note here and we'll follow up with the numbers.
Yeah, thank you for that. I will make sure to put that in our follow-up materials. Okay, everyone, well, thank you all so much. That is the end of our webinar. So thank you to our speakers and to all of you who are working to fight against the tax bill. So thank you all so much. So we will have the slides up and ready as soon as possible, and feel free to continue to tweet and to engage in social media. So thank you all so much, and have a great day.